everyone, and welcome to the Checkmate Real Estate Podcast, brought to you by CGE Studios, the multimedia company that encourages you to create, entice, and live nice, and WPKN 89.5 FM. My name is David Smith.
And I'm Anthony Ramo.
And
we have Asia.
Is the manager?
Is the manager.
I'll try to remember.
You did try to remember me. I mean, y'all could call me Asia, A Bowling, Biz the manager, whatever you guys want.
It doesn't matter. It's all the same. And today we have a very, very, very special guest. A man with a vast amount of knowledge and expertise in a multitude of fields. An award-winning data scientist turned commercial real estate investor with over 300 plus multifamily units acquired since 2020. Ladies and gentlemen, I give you Dr. George Roberts.
We're going to add
Thank you for that introduction. It's great to be here today.
Yes, sir. Yes, sir.
It's a pleasure to have you, George.
Very excited. Thank you for joining us on our show. It is a blessing, absolutely, to have you here. Before we begin speaking about your real estate journey, I'd actually love it if you could give us some insight on your initial career path. As I briefly mentioned, you were an award-winning data scientist and heavily cited bioscientist. And even before that, I actually saw that you spent some time in music. So, if you could just enlighten us a little bit about your life leading up to real estate.
Yeah, so I did start out in bioscience. It was great, very exciting. Loved being in tech. Wanted to go into something that would give me a little more time with my family. I thought that becoming a data scientist would help me do that, but realized that it was still a grind. There was no true financial freedom in it. And it was really my sister coming to me and saying, hey, let's start a construction company. Now that introduced me to entrepreneurship, and there was really no looking back at that point. I realized that the world of tech may be exciting, but there's just so much more out there.
Absolutely, man. So much more. And the fact that you diversify your fields so vastly, so you go into construction, and how was that initial conversation? It was completely left field, mind you, right? What was there a pitch to it? Were you just open to it, or how was that process?
Well, my dad always wanted to go and build on his property and never got the opportunity because global financial crisis came through and it no longer made any sense. So then, years later after he was gone, we decided, hey, we've got a rising real estate market. It probably makes sense. Let's go and do this right now. And it was really exciting to be able to go and help.
Starting as a data scientist and everything, I myself, I give you just the courage and the praise, because you had the patience to go to school for that long and take the time where, I think as a personal individual, I just can't do that. That's not my place. So I think it's amazing how you went from one field of your career to another that was a lot more freeing and, in your eyes, more beneficial to you.
Yeah, absolutely. So as you see a whirlwind of activity over here, I missed half your question, but it was, yes, quite amazing. Huge change for me, but something that suits me a whole lot better. It really suits my adventurous spirit.
No, absolutely. Now, I have a question. What was it about real estate that initially attracted you to it? And how did you get involved in it from the start, aside from, the construction side of things?
So I've been a landlord since the depths of the Great Recession. My dad really pushed me to go into it. He said, look, this really makes sense. You can't sell your home for anything right now, so just hold on to it. Become a landlord. And it seemed kind of crazy at the moment because working in a bioscience lab all the time, I really didn't feel like I had time for a side hustle. But I found that it was wonderful, and it really was essentially passive. So once I got everything set up, we got our leases, we have everything in order at the property, we got good tenants in there. The place just ran itself for about 7 years. So then when I decided I wanted to come back to, that I wanted to go into entrepreneurship, I was really just coming back to real estate, and this time doing it more seriously. Meanwhile, as I mentioned, I became an award-winning data scientist. Well, I was always scanning the horizon for better ways to invest, and multifamily really caught my eye. I decided, well, hey, why don't I go back to real estate, but this time let's do it at scale.
Now, one last question with that segueing into, what David's going to say, I'm presuming, you seem like a very data-driven person, and talking about scale, you just ended your last, sentence with, how is it any easier to scale on that size? A lot of people are hesitant when it comes to starting in real estate in general. Everybody wants to start on a smaller level sometimes. How is it easy for you to just go into it at a scalable and big size like that?
So I would say it's definitely not easy. Again, I think that it's probably much easier to go into single family real estate, but as you mentioned, scaling is the issue. So the question is, how many units do you want to have to acquire to become financially free? Now, if the number of transactions you have to do to get to that point is equal to the number of units, that's a lot of transactions, and you're going to spend a lot of time just making those deals happen. A lot of it, I think, is very dispositional. It's what you like to do. If you find it exciting to put together really big deals, which I do, then I think you really love the world of multifamily real estate. You get to do a smaller number of transactions, but it's really exciting. When you close on 25, 50, or 100 units, it's just a completely different feeling.
Absolutely. No, that's great. And so with those, the data-driven analytics, kind of segueing into my question actually as well. I kind of saw it on your page. You're big on teaching macroeconomics and emphasizing macroeconomics. So if you could just explain to our viewers a little bit exactly how you utilize that and your investment strategies and how you use it towards your benefit.
Well, I think the first thing you need to do is make sure you fully understand the financial landscape. Understand, how, for example, bond investors impact real estate. When you have things that go wrong in the economy, like a few years ago would be, trying to think, Kim Jong launching a missile. Then everybody gets frightened. They go out of the stock market. They put their money into bonds. Well, that increase in demand for bonds, that's going to decrease the interest rates, and it's going to make it a better time to go and buy real estate. So you really have to understand from many different angles. So what influences the rates that you're going to pay on the primary market? Well, it's a lot of things. It's the investors, it's the Fed and their open market transactions. And when you're able to sort of put that together, it makes the investing world a whole lot less scary.
Wow.
No, that makes a lot of sense. Absolutely. I think, that's the biggest factor as a new investor, is really understanding the market that you're getting into. Being so young, I've had to come to understand past markets, this current market that we're dealing with. And obviously it's very rough with the rising interest rates and everything that you were just talking about. And, with that being said, as a new investor, I think that's the one thing someone needs to worry on when they're teaching themselves, when they're learning from other people, is like really just getting good at the macroeconomics of things and understanding, like George said. So that's something that I myself have been working on and getting better at doing too.
I have a quick question for George. You had mentioned that like when people were like when bond prices like went up and people were more demands were for bonds, that interest rates lowered. Can you give me a couple examples of what would like raise interest rates, and like when a time to like maybe pump the brakes is, or something like that? Or is raised interest rates a time to pump the brakes? Like, can you give me a little bit of insight on that?
Well, yeah, I like the way you're asking the question because it's never quite that clear. So what happens is that when people go risk on and they go all into the stock market, you see less people buying bonds. That's the number one issue. You can also see issues with, for example, the Fed. Now, things are very odd right now. We've been in quantitative easing for over a decade. And so when they just simply stop buying bonds on the open markets, then that also is going to increase your interest rates. So does that mean that it's necessarily time to stop buying, pump the brakes on real estate? Not necessarily. For example, we're at a high interest rate environment right now, but we think we're towards the top. And I think what we really need to do is sort of zoom out. Now, if you say, hey, are we at the top? I don't know. Do I look like I have a crystal ball? None of us know what's going to happen next, but I would say that if you take a zoom out and you take a look from, say, a 2, 5, 7, or 10-year perspective, we're very close to the top. So this could be one of the very best times to buy real estate. Prices have softened a little bit, although they're already recovering on the single family side as we record here late in June of 2023. But at the same time, if interest rates begin to fall, and they may fall anywhere between, say, 6 and 12 months from now, depending on other economic events, then the value of real estate, I think, is going to shoot up rapidly. So just because rates are high doesn't mean it's a bad time to buy. It can be the best time to buy.
Well, actually, like, honestly, I like that advice because it's different than what I've heard from everywhere. Like, a lot of people are like, oh, interest rates are high, wait, don't buy now, et cetera, et cetera. Because, I mean, also the prices are a little high, but they're coming down. Like he said, it's on the downtrend. But everybody's like, just like, wait, don't buy. But it's like, in reality, especially if you're doing single family, you could buy now at maybe a cheaper price and then refi when the rates go down. That's always an option. So, like, definitely like hearing that nugget of something different, because a lot of people are just saying the same thing, and it just shows to why you separate yourself, kind of.
Yeah,
it's true. And that's probably what keeps you ahead of the competition.
I'm sorry, George, what were you saying?
Yeah, I got to stay ahead of the competition any way you can. And the sort of financing that you pursue, knowing where we're at and how much that's going to impact the future. Right now, for example, you have a agency loan. You don't want to have yield maintenance. If you have a step down, that's perfect. Suppose you have a 5 year, and it depends, but you can have, say, a 3-2-1-1-1 step down. That's the perfect sort of loan to be in, because I don't know what's going to happen in 6, 12, or 18 months, but I'm pretty sure that 2 years from now, we're going to be in a significantly lower interest rate environment. And if I can get out of that loan for 1%, that's perfect. If you've got seller financing, in most cases, you don't even have a prepayment penalty. So that's another type of loan that's really great to be in. I know people are always very excited about the 100 and 200 unit apartments, and it's great to play in that space. But this may not be a bad time to play in the 30, 40, and 50 unit space. If you get that seller financing, you've got no prepay penalty, then you can get out of that whenever you want. A lot of people who have larger properties, they're going to have a harder time.
Now, I like that you mentioned seller financing. Is that something that you like to implement into your own business structure as well?
I love it. And a lot of people say, hey, that doesn't really work so much with multifamily, or you can't do it with a larger number of units. That's true. But again, just look at how good the deal is. If you've got a great deal with a lot of meat on the bone, a medium-sized deal that with a lot of meat on the bone can beat some of these larger deals, because you always got huge competition for the larger numbers of units. If you got 100, 200 units, whether that goes on the market or even if you get it off market, there are going to be some very big buyers that are going to see that concurrently with you. And it's going to be very, very hard to be the only player on the field.
Oh, absolutely. Now, how do you approach going at sourcing deals, I should say? How does your team approach sourcing deals? Do you like on-market stuff? Do you prefer off-market? I feel like most people prefer off-market, but what's your stance on it?
Well, sure. As soon as you can get to the off-market deals, the sooner the better. We do a variety of things. We do call brokers. We do have established relationships with brokers. We've brought through brokers in the past. But to tell the truth, it's just interactions like this, going out on podcasts and my social media presence, being the data scientist of real estate on YouTube. People are just sending me deals, and I find that a lot more gratifying. So I would encourage your audience, if you have something that you think would match my interests, and we'll get deeper into that and what my wheelhouse precisely is as we go on in this podcast, I would highly recommend send it to me, even if it's at an earlier stage. I don't mind mentoring people. I find a lot of gratification in it, and it's a whole lot better than sifting through 100 deals that come from a broker And 95% of them are not even anywhere close to penciling.
Exactly. Yeah. I feel like the viewers, they're very hungry. That's how all of us started, as just very hungry individuals just wanting to make a piece of the pie. So
Yeah, man, absolutely, like super hungry. And that made me want to ask a question, George. Like, so can you explain about your first deal? Like, how did that go? And were there any pitfalls? Were there any challenges? And did you have to, do a little remixing, reverting here and there? How'd you get that done?
Yeah, the first deal was really great as an example because there was everything involved. There was seller fatigue. He'd been through two buyers that had fallen out and was willing to lower the price, just wanted somebody who could get the deal done. And even though we were new, we just projected that we were somebody who could get the deal done. In fact, they never even asked us for proof of funds until we were already under contract at that point. It was kind of superfluous, but we were able to do that. And it was during COVID. So just set the scene. Prices, people expected to soften a little bit. I think it happened in certain transactions, not so much on the aggregates. And a lot of people said, hey, let's pull back. A lot like what you were saying earlier, Asia, that many people are saying, hey, maybe this is not the time to buy. And we were hungry. We knew our numbers. We had a seller who was willing to come down a little bit, which was very helpful. And the deal was a total home run. We were able to fully reposition it. We have a completely different tenant base. We went from 13 units to 14. We got a C of O for the 14th unit, which was a fight in and of itself. And now we're looking at the ability to refinance, even at these higher rates, at about 3 times the initial purchase price.
Oh, wow.
So total grand slam home run.
wow, that's a big win for your team,
Oh yeah.
especially being the first deal.
Yeah.
Now,
Yeah, and you got to be careful the first time out. I mean, it makes sense to be a little bit more careful because a bad deal will hurt you a lot more than missing a good deal would have helped you. So, yeah, you want to hold out on that first deal. Make sure it's a good one because that's going to pave the way for the second, third, and fourth to hopefully follow very closely on the heels.
absolutely, it's the law of attraction. It's just getting the ball rolling and then watching it all fall like dominoes. Now, I have a question for you when it comes to the viewers, and how would you tell them, or what would you tell them, the biggest thing that they should look out for when looking for their first deal? Like, what's some big advice that you could give them when they're trying to tackle their first multifamily deal?
Well, it's totally fine to go out and look for that super big deal. And particularly if you're in a mentoring program, it may very well be possible for you to come and pull down a 100 or 200, even larger deal the first time around. And that's okay if you do, but keep your eyes open. We were looking for a 100-unit deal like everyone else, but a 14-unit deal dropped into our laps. So keep your eyes open. You need to focus. Find your market, know your niche, but when you see something where the numbers work, don't be afraid to pull the trigger. You'll be much further down the road to take a 10 or a 20 or a 30 unit when you're looking for 100 than to wait for the perfect deal to come along.
That's amazing advice.
That really is.
Yeah, slow and steady wins the race, man. Wow. And so you started, like, your first units you said were during the pandemic that you got, right? Yeah. So now, did the pandemic change or influence the way you went about real estate? I know, things were fluctuating around that time and all.
Well, I think it was just a matter of whether you had confidence in the numbers or not. So for us, it made sense. And so we pulled the trigger. As for things being different, I mean, sure, supply chain disruptions made it difficult to get things done. And, maybe a little slower getting building permits and getting inspections and things like that, getting the contractors out there. But I think really in the end, again, it either makes sense to buy or it doesn't. And, there's always a good deal out there in any market, no matter where you are. There's always a good deal at a particular time, even when the market is headed down. And so you really just got to look a little harder when things are difficult.
Now, I feel like that's always amazing to do, always stick to the numbers and make sure it makes sense at the end of the day. But what if it makes sense? What if to these, to people who are just starting in the industry, their nerves are a little shaky, this is their first deal in general, and they're tackling a 10-unit deal. The numbers make sense. What would you tell them? Because we're big on mindset on this podcast as well. Mm-hmm. How would you tell them to transform their mindset into feeling confident and capable of tackling that size of a deal despite not having any experience? Like, would you put people around you that are smarter? Would you work with more experienced people? What would you do yourself as an individual to prepare yourself?
Well, partnering up is always a great thing to do. And you speak of finding people that are smarter than you. Absolutely. If you feel like the smartest person in the room, you need to find a different room. And you always want to push yourself in that respect. So if you're out there and you think, well, I think these numbers make sense, and I'm not sure if I'm quite ready to pull the trigger. The other thing is, how are you partnering up? So certainly you want to take somebody who's at or above your level. That's the goal. But make sure that you find somebody who's your foil. Do you have somebody on the team who's a great communicator who can go out there and source the deals? Do you have someone who's great at the numbers and can make sure that you're not making a mistake? Are you the sort who actually dots the I's and crosses the T's? Not necessarily the same person as your numbers guy, because when it comes to your due diligence, a lot of that is very qualitative. So make sure you have the right team. You don't have to pair up too early, but you want to, I would say, at least you want to find your team that you're looking for deals. And remember that throughout your career, this is a field where you can pair up with a different group of people on every deal. So you're not married. Go out there, figure out how to take deals down. And then, if another group comes along that can help you take down a different type of deal, then just be open to it. So I think a lot of it has to do with partnering up. But without a doubt, there is a certain degree of mindset to it. And maybe the best thing to do is just keep your eyes on the size of the prize. If you can pull down even a 2 or a 4 unit, you're already doing, say, 2 or 4 times better than most people when they start out in this business. So whatever you get in the multifamily space, even if it's residential multifamily under 5 units, realize that that is going to be a game changer in your life.
Yeah, and I mean, I love that you said that, and because a lot of people, like in my circle, in our circle, have like really started that, and they don't understand where they are in life, like where that set them up to be and what they can do with the asset that they already have under management. And but to go back to what you were saying, I almost want to piggyback off of Ant. Like, when you guys say the numbers make sense, like what numbers and like how do they make sense? You know what I mean? Like, I'm an example of a novice guy who doesn't really know much, so I'm trying to learn.
Oh, I love it. And that's a perfect example, because when I see people talking about numbers making sense, usually they just show their underwriting and say, hey, look, we can make these great returns. Well, can you? It's not always quite so clear that that's the case. So you got to look at a lot of things, both quantitatively as well as qualitatively. Like, say we're going to go and look at a real estate market. First thing I would say always, you want to understand macroeconomics and housing economics. Like, what situation are we in right now? Well, we're way underbuilt, okay? So that's hugely supporting prices. But now you got to go down to your market. So at the market level, well, what's the 12-month absorption? How many things are expected to be built in the next year? So what's your projected absorption? You want to know the demographic story. Are people moving in? Are there new jobs in your area? What employers are coming in? Here's another qualitative angle. Call up the Chamber of Commerce and just ask, who's coming? Got a deal going right now where I called up the Chamber of Commerce. It's a rural county. And they gave me all kinds of information, stuff that would have been really hard. I read about 100 articles on the area, but they still knew about businesses that were coming to town that I didn't know they had the backstory. So make sure the demographic angle supports your numbers. Now, if you see people saying, hey, we're going to get 5% rent growth a year, well, I hope you do. But how is that going to happen? Is it going to happen out of inflation? Well, then your expenses are probably going to go up 5% too. if you have really strong rent projections, but your expense escalator is not also somehow in balance. And again, I'm not saying necessarily that they have to be the same number or that you have to set your expenses above your rent escalator to make sure that you are being conservative enough, but really, really be able to back up those numbers. So you got to know the numbers, you got to know the qualitative story, and make sure that every number in that spreadsheet can be justified, from the rents that you think you can charge to how much you think it's going to cost to repair that roof in 5 years.